It is May 5th, 2026. And if you are looking at the global markets today, you are probably getting some severe financial whiplash.
Oh, absolutely. It's totally, completely disjointed right now.
Right. I mean, on one hand, a drone just struck a massive oil pipeline in the United Arab Emirates. Traditional global banks are actively hoarding cash, like literally preparing for supply chain fallout.
Bracing for impact.
Yeah, bracing for impact, and yet somehow Wall Street is just popping champagne. U.S. indexes are hitting all-time highs. It is this complete paradox. Today, we're doing a deep dive into a market that has effectively split into two alternate realities.
Yeah, you have the physical world, which is grounded by, geopolitical friction, labor wars, physical supply constraints.
Hmm.
And then on the other side, you have the digital world, right?
Mhm.
Driven by this limitless, almost ravenous artificial intelligence supercycle.
And those two realities are colliding violently on corporate balance sheets today. I mean, the market is attempting to price in a digital utopian future while simultaneously dodging literal real-world missiles. It's wild. So our mission today, we have a massive stack of sources to get through. Financial reports straight from the SEC, breaking macro analyses out of Europe, supply chain data, and a truly bizarre hostile takeover bid that we will get to later.
That one's going to be fun to break down.
Oh, it's insane. But we aren't just going to list numbers today. This is an exercise in critical thinking. We need to figure out the mechanisms underneath the numbers, like how a semiconductor company in California is actively reshaping sovereign defense strategies in the Middle East.
Right. Or how an e-commerce giant is weaponizing its internal algorithms to just obliterate century-old shipping monopoly.
Exactly. So let's go straight to the epicenter of all this optimism, Advanced Micro Devices, AMD. They just reported first quarter revenue of $10.3 billion.
Which is massive.
Yeah, it's a 38% jump year over year. But the real story isn't the aggregate number, is it?
No, not at all. It's their data center segment. That segment alone pulled in $5.8 billion.
Wait, just the data centers?
Just that one vertical. We are looking at a 57% explosion in just that area. I mean, Dr. Lisa Su has completely re-architected AMD around this specific AI demand curve.
So they aren't just making, like, gaming chips anymore.
Right. They are no longer just a chip company competing for desktop computers or Xboxes. They are the architects of the foundational infrastructure required to run global AI.
I really want to stop on that 57% growth figure because I think, people hear these tech numbers and just get kind of numb to them.
Oh, the numbers lose all meaning.
Exactly. A $5.8 billion quarter for a hardware division means they are shipping physical, heavy, highly complex silicon at a volume that is just hard to wrap your head around. And the demand isn't for, like, basic generative AI anymore.
No, the earnings call specifically cited inferencing and agentic AI as the main drivers.
Okay, let's unpack this because that distinction is critical to understanding the hardware demand, right?
It is. Generative AI is, asking a chatbot to write a poem or render an image. That requires massive compute for training the model, but the output itself is static.
You ask a question, you get an answer, it stops.
Exactly. But agentic AI is an entirely different beast. These are autonomous AI systems that don't just generate a response. They take continuous iterative actions across software ecosystems.
Like acting as an actual agent?
Yes, they monitor networks, they execute trades, manage supply chain logistics, and, crucially, they correct their own errors in real time.
So they are constantly on and constantly thinking.
Precisely. And to run millions of autonomous agents simultaneously, hyperscalers just cannot rely on legacy server architecture.
It would just meld.
Exactly, yeah. The computational density required for agentic inferencing necessitates the exact type of high-performance accelerators AMD is building. Specifically, their new Instinct MI450-based GPUs.
Which explains why procurement is happening on a scale that mimics, like, nation-state infrastructure.
Let's talk about that scale, actually, because the Meta partnership blew my mind. The gigawatt numbers.
Yes. Meta, the parent company of Facebook and Instagram, they are deploying up to 6 gigawatts of AMD Instinct GPUs. I had to actually look up what a gigawatt translates to in the real physical world.
It's a lot of power.
It is. 1 gigawatt is roughly the energy required to power a mid-sized American city. So Meta is building 6 cities worth of pure electrical draw just to process artificial intelligence.
It completely redefines the concept of capital expenditure. I mean, when Meta commits to a 6 gigawatt deployment, they aren't just buying silicon from AMD.
What else are they buying?
They are securing land, water rights for thermal cooling, dedicated power grids. We are witnessing the literal industrialization of artificial intelligence.
So it's not a software deployment anymore. It's a heavy industry rollout.
Exactly. And Meta is not an outlier here. AWS, Google Cloud, Microsoft Azure, Tencent, every single major cloud provider announced massive multi-year expansions powered by AMD's 5th-gen EPYC processors.
It's an arms race. And AMD is essentially selling the titanium. But, I want to challenge the sustainability of this for a second.
Sure, go ahead.
We've seen hardware supercycles before, right? Like telecom switches in the year 2000, networking gear. Eventually, the data centers get built, the capacity is reached, and the bottom just falls out of the hardware market. Why isn't that happening here?
That is the historical precedent, yeah. But the financial metrics suggest we're still in the acceleration phase, not the plateau. AMD isn't just selling more units, they are extracting way more value per unit.
How so?
Their non-GAAP gross margin hit 55%, and their operating income was $2.5 billion. That's a 25% operating margin.
Wow.
Right. When a hardware company scales revenue by 38% and still manages to hold a 55% gross margin, it tells you they possess immense pricing power. The hyperscalers are not negotiating on price.
What are they negotiating on, then?
Delivery timelines, they don't care what it costs, they just need it plugged in yesterday.
That is wild. Which actually brings us to the most baffling earnings report of the entire week. Supermicro, or SMCI.
Oh, this one is fascinating.
It really is. So they design and manufacture the physical server racks, right? The liquid-cooled, high-density metal housing that actually holds all these AMD chips.
Yes, the physical infrastructure.
And their Q1 results broke every traditional rule of Wall Street expectations. I want you to walk me through the logic here, because on the surface, it looks completely insane.
It was a massive stress test of how institutional investors value growth versus profitability.
Okay, let's unpack this. SMCI reported Q1 revenue of $10.24 billion. Wall Street analysts had a consensus estimate of $12.38 billion. So SMCI missed their revenue target by over $2 billion.
A massive 17.3% miss.
Right. Usually, if a hyper-growth tech company misses top-line revenue by $2 billion, the stock is sent to the slaughterhouse. It drops 20–30% overnight.
Historically, yes.
But SMCI, the stock surged 11.6%. Okay, here's my analogy. If you run a bakery and you sell 2,000 fewer cupcakes than Wall Street expected, your stock usually plummets. Why is Wall Street giving a standing ovation to SMCI for a $2 billion revenue miss?
What's fascinating here is that in the hyper-specialized world of AI server manufacturing, top-line revenue is no longer the ultimate arbiter of health. You have to look at the severe bottleneck in the supply chain.
So they didn't miss because people didn't want the cupcakes.
Exactly. SMCI didn't miss their revenue target because of a lack of demand. They missed it because they're physically constrained by component availability and the sheer engineering complexity of what they are building.
So they are selling every single rack they can possibly screw together.
Yes. And more importantly, the racks they're shipping are radically more profitable than analysts anticipated.
Because of the margins.
Right. While they missed the $12.38 billion revenue target, their adjusted earnings per share, the actual profit generated, came in at 84 cents. That completely crushed the estimate of 62 cents.
They beat bottom-line profit estimates by nearly 35%. How does a company manufacture $2 billion less product than expected, but make significantly more money?
It comes down to their liquid cooling technology and proprietary architecture. Historically, assembling servers was a low-margin, commoditized business.
Just putting parts in a box.
Yeah, you buy the chips, you put them in a metal box, you add some fans, you sell it at a 4% margin. But AI chips run so incredibly hot that traditional air cooling is physically impossible.
Right, they would just catch fire.
Basically.
Mm-hmm.
SMCI has cornered a significant portion of the market for direct-to-chip liquid cooling infrastructure.
So they aren't just selling metal boxes, they are selling highly engineered thermal management systems.
Exactly. And because the hyperscalers are desperate for these specific high-density liquid-cooled racks, SMCI has extraordinary leverage. Their adjusted operating margin improved to 7.3%, up from 5% a year ago.
That's a huge jump.
In the server manufacturing industry, a 230 basis point jump in operating margin while scaling top-line revenue at 123% year over year is almost unheard of. It proves they aren't just buying market share.
They are dominating a highly lucrative, specialized niche. So going back to the bakery, it's like they promised Wall Street 10,000 cupcakes. They only baked 8,000 because of a global flour shortage. But they figured out a way to bake them using half the electricity, and the customers were so desperate they paid double the price.
That's a perfect way to look at it. Wall Street looks at the bottom line and says, We don't care about the 2,000 missing cupcakes. Your business model is actually a gold mine.
And they had massive forward guidance too, right?
Oh, yeah. SMCI projected Q2 revenue of $11.75 billion at the midpoint, which is roughly $800 million higher than analysts were forecasting.
So the backlog is just massive.
Huge. They guided for an adjusted EPS of 72 cents next quarter, easily beating the 56-cent estimate. They basically told the market, yes, supply chain bottlenecks slowed us down, but our margins are expanding and the floodgates open next quarter.
And it isn't just Meta, Google, and Amazon standing in line for these racks. The source material outlines a massive geographical expansion of this demand.
The sovereign AI initiatives.
Yes. We are seeing AMD and SMCI hardware being deployed for these nation-state projects. Tata Consultancy Services is co-developing AI infrastructure for localized deployments in India. Naver Cloud is doing the exact same thing in Korea.
This is a really critical evolution in the market. 2 years ago, AI was viewed purely as a corporate enterprise tool, something to make businesses more efficient.
Right.
Today, governments view localized high-performance computing as fundamental to national security and economic sovereignty.
But I have to push back on that a bit. Is a sovereign AI initiative an actual technological necessity, or is it just like political theater? Are governments just buying multi-billion-dollar supercomputers so politicians can cut a ribbon and say they aren't falling behind Silicon Valley?
Oh, it is far beyond political theater. It is a direct response to global data localization laws and the threat of export controls.
Oh, so.
Nations have realized that if their defense networks, their financial systems, and their public utilities become reliant on an AI model housed in a server farm in Oregon managed by an American corporation.
They've effectively outsourced their national nervous system.
Exactly. India and Korea want foundational models trained on their own citizens' data, in their own languages, housed within their own borders, completely insulated from foreign sanctions or physical network severing.
Wow. And that desire for technological insulation brings us to a much darker, much more immediate reality. Because while India and Korea are building sovereign AI for the future, the United States military is actively deploying it in live theaters of conflict today.
Yeah, we have to look at Palantir.
We do. We need to look at how this technology is fundamentally altering global defense. And I should note here for you listening, we are carefully and impartially reporting the facts of these global conflicts as they are detailed in our financial sources. We aren't taking any political sides here. We are merely reflecting the reality of the geopolitical landscape.
Right. It's a sobering transition, but you just cannot analyze the global market today without factoring in the monetization of geopolitical instability.
Very true. So Palantir. They build highly classified data integration and AI platforms primarily for the intelligence community and allied militaries. They just reported their strongest growth since going public in 2020.
The numbers were staggering.
Total revenue shot up 85% year-over-year to $1.63 billion. U.S. commercial revenue jumped 133%. But the number that really anchors this to current events is their U.S. government revenue,
which climbed 84% to $687 million.
That is an acceleration from the 66% growth they reported just one quarter prior.
And we need to dissect what that software actually does in a combat scenario to understand why governments are accelerating their spending at this rate.
Here's where it gets really interesting, because their CEO, Alex Karp, made a very specific operational claim in the earnings release. He said their AI software compresses military targeting cycles from days down to minutes.
Which is a massive paradigm shift.
I need you to explain the mechanics of that. I mean, think of Palantir as upgrading the military's nervous system. But how does a piece of software actually take a 3-day military operation and execute it in 3 minutes?
It is all about overcoming the friction of data silos. Historically, if a military wanted to identify a target, they had to manually synthesize disparate streams of intelligence.
Like different teams looking at different things.
Exactly. One team is analyzing satellite imagery, another team is looking at intercepted radio communications, a third team is monitoring drone feeds, a fourth team is tracking logistics movements.
And these are all separate systems.
Massive disconnected databases. A human analyst has to pull a piece of data from one system, cross-reference it with another, verify it, and pass it up the chain of command. That process inherently takes...
It's an administrative bottleneck.
Exactly. But Palantir's AI platforms, specifically their artificial intelligence platform, or AIP, ingest all of those disparate data streams simultaneously in real time.
So it's looking at the satellite and the drone feed at the exact same moment.
Yes. It uses machine learning algorithms to instantly fuse a synthetic aperture radar image with a localized RF emission and a drone's optical feed.
Wow.
The AI identifies the anomaly, cross-references it against known enemy asset profiles, calculates the optimal weapon system required to neutralize it, and presents a fully vetted targeting package to a human commander for authorization.
It effectively removes the human from the data gathering and synthesis phase entirely. The human is only there to pull the final trigger.
Yes. And in modern warfare, speed of decision-making is the ultimate tactical advantage, which is why this capability is not a luxury for the U.S. military anymore. It is an absolute operational mandate.
And we are seeing the exact environment where this speed is required playing out in our macro sources today. The backdrop to Palantir's blowout quarter is an acute, escalating conflict in the Middle East.
Right, the situation with Iran.
Yeah, Iran has broken a regional ceasefire and fired drones and missiles at the United Arab Emirates. And they specifically targeted the Fujairah pipeline.
The geography of that specific strike is vital to understand the market's reaction.
Let's break down the map for a second. The Fujairah pipeline is critical energy infrastructure. It carries up to 1.8 million barrels of oil per day. But the reason it exists is the key point.
Because of where it's located.
Right. It was built specifically to bypass the Strait of Hormuz. The strait is this narrow choke point where a massive percentage of the world's oil transits, and it is highly vulnerable to blockades or naval harassment.
So the UAE built this pipeline so they could load oil onto ships safely on the other side of the Arabian Peninsula.
Completely avoiding the strait.
So when a missile strikes the Fujairah pipeline, it isn't just an attack on an oil pipe. It is a calculated strike against the region's primary fail-safe mechanism.
It signals to the global energy market that bypassing the choke point is no longer a guarantee of safety.
And the market reacted immediately to that.
It did. Oil prices spiked, sovereign bond yields rose, and the reality of this geopolitical friction slammed right into global supply chains. But this brings me back to Palantir. There has been this persistent narrative among tech skeptics that the current AI boom is just like an echo chamber.
Ah, right.
You know the argument. A hyperscaler buys chips from AMD, AMD buys cooling from SMCI, SMCI buys software from Microsoft. It's just the tech sector passing the same $1 trillion back and forth without actually extracting money from the real world.
The circular economy critique.
Exactly. But Palantir completely destroys that argument, right? How do investors balance the ethical weight of these defense trades with these undeniable record-breaking margins?
Well, Palantir is the counterargument made manifest. They are not selling software to other AI companies. They are selling it to the Department of Defense. They are extracting capital from massive real-world defense budgets.
And the margins are huge.
Their adjusted free cash flow hit $925 million with a staggering 57% margin.
Yeah.
That is highly lucrative real-world value creation driven entirely by artificial intelligence. What we're seeing is the Iran war premium showing up directly on these tech balance sheets.
And this is the tension I mentioned at the very beginning. Palantir is monetizing this geopolitical chaos. They are building the software designed to navigate and win in a world where drones are striking pipelines. The AI sector is thriving on this complexity, but someone actually has to finance the physical trade that is getting disrupted by those missiles. The global economy still requires cargo ships, physical oil, and credit. And that is where the traditional banking sector is currently having a localized panic attack.
If we connect this to the bigger picture, unlike Palantir, a commercial bank cannot algorithmically route around a destroyed pipeline. They have to absorb the financial loss of the disrupted cargo. Banks are the ultimate shock absorbers of the macroeconomic environment.
Which brings us to the latest report from CaixaBank Research and the Q1 earnings from HSBC. Let's start with a macro picture. CaixaBank is reporting a significant deterioration in risk sentiment across Europe.
Yeah, things are looking shaky there.
They are tracking rising sovereign bond yields on both sides of the Atlantic, explicitly tying it to the oil price volatility caused by that UAE pipeline strike. Now, to be fair, oil prices did cool off about 4% later in the trading session.
Which is what gave the U.S. indexes enough breathing room to rally.
Right. The S&P 500, the Dow, and the NASDAQ hit new all-time highs. But how real is that?
That late-day equity rally masks the severe defensive posturing happening within the credit markets. If you want to understand the true health of the global economy, you don't look at a tech-weighted stock index. You You look at a commercial bank's balance sheet.
Okay, let's tear down HSBC's balance sheet then, because at first glance, it looks like a fortress.
It really does.
They reported a $9.4 billion first quarter profit before tax. Revenue is up 6% year over year to $18.6 billion. And their annualized return on average tangible equity, their ROTE, was 17.3%.
ROTE is a metric we should really isolate here.
Yeah, explain that for us.
Return on average tangible equity essentially measures how ruthlessly efficient a bank is at squeezing profit out of hard, measurable assets. It strips out all the accounting fiction like goodwill or the theoretical value of a brand name.
So it's just the cold, hard cash and physical assets.
Right. It looks purely at the physical capital owned by shareholders and asks, what percentage yield did management generate from this? A 17.3% ROTE is exceptionally strong for a bank of HSBC's size. It shows they are running a highly profitable core lending operation.
But when you look underneath the hood of that $9.4 billion profit, HSBC is actively bracing for a massive macroeconomic impact.
The expected credit losses.
Yes, their expected credit losses, their ECL, spiked to $1.3 billion for the single quarter. Just to clarify, this is cash they are legally required to quarantine because they believe their borrowers are going to default.
Right. It is essentially a predictive financial model made tangible. An ECL isn't a realized loss yet. No one has necessarily defaulted yet.
So it's not missing money.
No. It is the bank's risk department, using stochastic modeling, overlaying current macroeconomic data like inflation rates, oil volatility, and geopolitical conflict, and mathematically projecting how many businesses will fail to pay back their loans in the near future.
And then they quarantine that money.
They take that projected loss directly out of their current earnings and set it aside.
And that rainy day fund just grew by $400 million compared to last year. When you break down the $1.3 billion, it reveals exactly what is terrifying the banking sector.
There were two main components, right?
Yeah. There is a $400 million overlay for a fraud-related securitization exposure in the UK, which is bad enough. But more importantly, there is a $300 million overlay explicitly linked to the deteriorating forward economic outlook due to the onset of the conflict in the Middle East.
So HSBC is looking at the drone strike on the Fujairah pipeline, looking at the potential for expanded regional conflict, and quantifying the exact dollar amount of damage it will do to their loan book.
They are putting a price tag on war.
Exactly. They're provisioning for a scenario where shipping lanes close, energy costs spike, inflation rebounds, and their commercial clients can no longer service their debt.
They are so convinced of this physical friction that they actually raised their ECL guidance for the full year of 2026. They moved it from 40 basis points up to 45 basis points of average gross loans.
And they were very explicit about why.
They were. They explicitly cited, quote, heightened uncertainty and volatility in both economic forecasts and financial markets.
Which creates the exact paradox you highlighted at the beginning of the show.
So what does this all mean? I cannot reconcile these two realities. At 3:30 p.m. today, algorithms are buying tech stocks, pushing the S&P 500 to a literal all-time high, completely euphoric about the future.
Right.
And at the exact same moment, HSBC's risk managers are locking $1.3 billion in a vault because they believe the global supply chain is teetering on the edge of a conflict-driven recession. They are looking at the exact same world. Who is wrong?
It isn't necessarily that one is wrong and one is right. It is a massive divergence in duration and exposure.
Explain that.
The stock market, specifically the U.S. indexes right now, is heavily concentrated. A handful of mega-cap tech companies drive the vast majority of the index's performance. And those tech companies are highly insulated from physical supply chain friction.
Because they sell software.
Exactly. Microsoft's software margins don't collapse if a shipping container is delayed in the Strait of Hormuz. Investors are buying the equity market as a call option on a digital future where AI drives boundless productivity.
But the banks don't live in the digital future.
No. HSBC deals in the heavy physical reality of tomorrow morning. Their clients are manufacturers who need raw materials, logistics companies that burn diesel fuel, and retailers who need physical inventory to sell.
If a pipeline is struck, those businesses fail.
And those loans default today. The stock market is trading on the premise that technology will transcend physical borders. But the banks are provisioning for the reality that physical borders are currently on fire.
The digital world versus the physical world. And that perfectly sets up the most aggressive corporate maneuver we have in our sources today.
Oh, this is the Amazon story.
Yes, because the digital titans aren't just sitting in their insulated server farms anymore. They have realized that the physical world is fragmented, inefficient, and vulnerable. And they're actively weaponizing their technology to conquer legacy physical industries.
We are talking about the collision of Amazon and the legacy logistics duopoly of UPS and FedEx. This is a structural siege.
The news dropped this morning that Amazon is launching a new initiative called Amazon Supply Chain Services, or ASCS. Essentially, Amazon has spent the last 2 decades building an incredibly complex, ruthlessly efficient, end-to-end internal logistics network just to deliver their own packages.
Prime delivery.
Right. Now they're opening that entire network up to the external market. Any business anywhere can now use Amazon to ship their freight.
And the sheer physical scale of the infrastructure they are opening up is staggering. It is an immediate, violent disruption to the supply side of the global freight market.
We are talking about 80,000 trailers, 24,000 intermodal containers, and an air fleet of over 100 cargo aircraft suddenly becoming available for commercial lease.
That's just an unbelievable amount of capacity to drop on the market all at once.
The market reaction was instantaneous and brutal. The moment Amazon announced ASCS, shares of United Parcel Service, UPS, and FedEx dropped by more than 10%. Billions of dollars in market capitalization wiped out in seconds.
Total panic.
I want to know why Wall Street panicked so aggressively. Because UPS and FedEx have been building their networks for a century. They have impenetrable moats. UPS moves millions of packages a day. They literally know every address on Earth. Why does Amazon entering the commercial space terrify them so much?
Because Amazon is not entering the market with the same cost structure. They are entering with a profound structural cost advantage that the legacy carriers cannot mathematically replicate. It comes down to a combination of labor arbitrage and the density of their automation.
Okay, let's break down the labor arbitrage first.
UPS operates with a highly unionized workforce. They recently signed a historic collective bargaining agreement with the Teamsters Union, which was a big deal. Huge deal. It secured significant wage increases, benefits, and workplace protections for their drivers and warehouse workers. FedEx is also facing aggressive, expanding unionization efforts at its regional hubs. Now, while those agreements are vital for labor stability and worker welfare, from a purely mathematical standpoint, they create a rigid, highly expensive cost base.
You can't just slash wages or double shift lengths to optimize a route if you have a union contract.
Correct. Now, contrast that with Amazon. Their fulfillment network is overwhelmingly non-unionized. That provides a baseline labor arbitrage that directly translates into lower per-package operating costs.
So they are already starting out cheaper.
But the labor cost is only half the equation. The real existential threat to UPS and FedEx is Amazon's capital expenditure in artificial intelligence and robotics.
But wait, UPS and FedEx use automation too. I mean, they have conveyor belts and barcode scanners. It's not like they were sorting packages by hand in a dirt lot.
They have mechanized sortation, yes.
Yeah.
But Amazon has achieved a density of predictive AI and robotics that is an entirely different paradigm. Amazon doesn't just scan a barcode. They use AI to dynamically reroute inventory across the country before a customer even places an order.
Pre-positioning inventory.
Exactly. Inside the warehouse, they have deployed hundreds of thousands of autonomous mobile robots, the Kiva systems.
Oh, those little orange Roomba-looking things.
Yeah, they physically bring the shelving units to the human pickers, completely eliminating the walking time. They're deploying robotic arms with computer vision that can identify, grasp, and sort irregularly shaped items at a speed human hands cannot match.
So they have stripped the human bottleneck out of the physical warehouse entirely.
They have compressed the unit economics of moving a physical box to a level that a unionized carrier relying on legacy infrastructure will struggle to match without bankrupting themselves. In the source material, financial analysts are explicitly referring to this as the AWS playbook.
And we have to dissect that comparison because it is the blueprint for how Amazon destroys legacy industries. A decade ago, Amazon Web Services, AWS, was not a commercial product.
Right, people forget that.
It was just a massive internal cost center. It was the vast server farms Amazon had to build just to keep their own e-commerce website from crashing during the holidays.
They had built massive excess capacity to handle peak demand, like Black Friday and Cyber Monday, which meant that for 9 months of the year, those servers were just sitting idle.
Right. So someone at Amazon realized, we have all this idle computing power. Why don't we just rent it out to other companies?
A brilliant pivot.
They opened up their internal infrastructure to the public, and it completely transformed the internet. It killed traditional data centers and created a high-margin growth engine that now funds Amazon's entire retail operation.
And now they're taking that exact same playbook, taking a massive internal cost center characterized by excess capacity and renting it out and applying it to the multi-trillion-dollar global freight market.
Amazon built 80,000 trailers to move their own boxes. Now they're going to rent the empty space in those trailers to anyone who needs to move freight.
It's the same exact strategy.
Imagine spending decades building an impenetrable fortress. You own the walls, you have an army of guards, you charge everyone who wants to pass through. That is UPS and FedEx. And suddenly, a $2.9 trillion tech giant just drops a high-speed rail line right over your walls and says to the world, hey, you can ride this for half the price.
It is a devastating competitive dynamic because Amazon is entering this war from a position of overwhelming financial supremacy. Their Q1 earnings were an absolute blowout.
Yeah, they posted earnings per share of $2.78, completely annihilating the consensus estimate of $1.63.
They have an almost limitless balance sheet. They can afford to run ASCS at a loss for years, engaging in a brutal pricing war of attrition simply to capture market share and bleed the legacy carriers dry.
And the legacy carriers are already bleeding. Our research includes the Tradesmith Health Indicator. It is a volatility-based measure that analyzes a stock's momentum relative to its historical baseline. Being in the red zone means the stock has broken down through its expected volatility bands and is locked in a statistically significant unhealthy downtrend.
And where is UPS?
UPS is currently deep in the red zone.
And they have been stuck in that zone for over a month. Even before Amazon dropped this ASCS announcement, UPS was struggling with a 1.4% year-over-year revenue contraction. The macro environment of high inflation and cautious consumer spending was already eating into their volume.
Now, UPS does have a massive 6.69% dividend yield, which is likely the only thing keeping income investors from entirely abandoning the stock right now. But FedEx is facing a much more aggressive, targeted attack from Wall Street.
The short interest.
Yes. While FedEx's recent earnings were actually somewhat robust, they posted an 8.3% revenue increase. Institutional money is smelling blood in the water. Short interest in FedEx spiked 23.6% in the last reporting cycle.
That is a staggering jump in short interest. For context, short selling involves borrowing shares of a stock and selling them with the intention of buying them back later at a lower price.
Of betting that the price will fall.
Right. When short interest spikes by 23.6%, it is a glaring, undeniable signal that large institutional investors, hedge funds, proprietary trading desks, are actively betting massive amounts of capital that FedEx's stock price is going to collapse.
And the optics of their internal leadership aren't helping. The sources note that a key executive and a director at FedEx sold off significant blocks of their personal shares in mid-April.
Just weeks before Amazon dropped the ASCS announcement.
Exactly. Now, whether that was a scheduled sale or not, the timing feeds into the bearish narrative that the people inside the walls know the fortress is compromised.
It creates a huge crisis of confidence. Can a legacy physical network, burdened by heavy human labor costs and traditional capital constraints, ever truly compete against a $2.9 trillion tech titan deploying AI-driven logistics at a global scale?
I really want you to ponder that question. Are legacy networks obsolete? Because we started this deep dive talking about how AI requires massive, heavy, hardware, liquid-cooled racks and gigawatts of electricity.
Right.
Now we are looking at how that exact same AI is being weaponized to undercut a century-old physical shipping industry. It truly feels like the physical world, the tangible economy of trucks and warehouses, is just being swallowed whole by the algorithms.
It is the ultimate test of legacy infrastructure versus tech-enabled disruption. And based on the violent repricing we saw today, the market has clearly placed its initial bets on the disruptor.
Okay. Up until this point today, everything we have discussed, while chaotic, has been driven by a ruthless underlying logic.
It makes mathematical sense.
Yeah. The buildup of AI infrastructure makes logical sense given the demand. Global macro hedging by banks makes logical sense given the geopolitical friction in the Middle East. Amazon's logistical warfare makes terrifying mathematical sense. But the market isn't a perfect machine. It isn't just algorithms and institutional risk managers. Sometimes human psychology hijacks the system and does something so absurd it defies all financial physics.
We have to transition from the highly calculated structural shifts to the highly unpredictable realm of retail sentiment.
Let's talk about the absolute wildcard of the day. GameStop and eBay. Yes, you heard that correctly. GameStop, the struggling video game retailer that became the poster child for the 2021 meme stock mania, is attempting a hostile takeover of the foundational e-commerce giant eBay.
The sheer audacity of this proposal is what makes it so difficult for traditional financial analysts to parse. The math simply does not align with reality.
It is completely broken math.
Okay, GameStop currently has a market capitalization of $10.7 billion. eBay is valued at $56 billion. GameStop is attempting to force a buyout of a company 5 times its size.
It's unheard of.
This isn't David and Goliath. This is like a local indie bookstore taking out a massive payday loan to try and forcefully acquire Barnes & Noble, Amazon Books, and a publishing house simultaneously. How is this even legally being entertained?
It hinges entirely on the financing structure they claim to have secured. According to the SEC filings and the leaked reports, GameStop claims they have access to $20 billion in potential debt financing, backed by TD Securities.
I have to stop you there. Is TD Securities insane? How does a bank underwrite a $20 billion loan for a $10 billion company whose primary business model is selling used physical video games in dying shopping malls?
It is a phenomenal risk. In a traditional leveraged buyout, the acquiring company uses the assets and the cash flow of the target company as collateral for the debt.
So they use eBay's money to buy eBay. Essentially, yes. TD Securities is likely looking at eBay's massive, highly consistent free cash flow and calculating that, post-acquisition, eBay's own revenue can service that $20 billion debt load.
Wow.
However, even if we assume that highly aggressive debt structuring is approved, a $20 billion loan leaves a massive $36 billion shortfall to reach the $56 billion valuation of eBay.
And that assumes eBay shareholders would even accept a baseline $56 billion offer, which they absolutely wouldn't in a hostile, uninvited scenario. They would demand a massive premium.
Exactly. The only way GameStop bridges that $36 billion gap is by issuing equity, meaning they would have to print and use massive amounts of their own GameStop stock as currency to pay eBay shareholders.
And this is where the internet culture collides with Wall Street mechanics. The social media reaction is completely polarized. Over on Reddit, specifically the retail trading subreddits, there is a faction that genuinely believes this is a masterstroke.
They love it.
They argue that if you combine GameStop's rabid, cult-like retail investor base with eBay's massive online marketplace infrastructure, you create an unstoppable, community-driven commerce empire.
And that sentiment is actively moving the market. On StockTwits right now, the message sentiment for eBay is tracking as extremely bullish, completely driven by the sheer hype and meme velocity of this hostile bid.
But the reality of trying to execute a $56 billion merger using internet hype as collateral is starting to crack, isn't it?
Oh, absolutely. The leadership dynamics are incredibly strained.
Yeah. Ryan Cohen, GameStop CEO and the architect of their meme stock revival, recently did an interview on CNBC, and it was incredibly tense. When the anchors pressed him on the actual granular structural details of how this debt would be serviced and how the equity gap would be bridged, he bristled.
You didn't have the answers.
He became defensive, falling back on vague platitudes about unlocking shareholder value without providing the actual mathematical blueprint.
And institutional money is running for the exits. This raises an important question about smart money versus retail sentiment.
Yeah.
The most telling indicator of the viability of this deal is the action taken by Michael Burry.
The Big Short guy.
Right. Burry, the famous investor who predicted the 2008 housing crash, had actually been a vocal supporter of GameStop's underlying value in the past. He was the one comparing Ryan Cohen's strategic vision to Warren Buffett just a few months ago.
Wow, really?
Yes. But on Monday, Burry completely dumped his entire position in GameStop. He liquidated it entirely.
He looked at the $56 billion hostile bid and realized the fundamental reality had entirely detached from the stock price.
But the fact that a $10 billion retail darling can even force a $56 billion tech giant to acknowledge a hostile takeover bid represents a fascinating evolution in market mechanics.
It really does.
Think about it. A few years ago, the meme stock phenomenon was rudimentary. Retail traders would band together on a forum, target a stock that hedge funds had heavily shorted, and mass buy the equity to force the price up, triggering a short squeeze.
Squeezing the shorts, it was just financial vigilantism.
Yes. But what we are witnessing today is an evolution of that power. This newly enriched, highly coordinated retail base is no longer just trying to pop the price of a stock. They are actively attempting to engineer massive, market-altering mergers and acquisitions.
They are trying to use their hyperinflated stock, a currency backed purely by internet sentiment, to swallow fundamentally stable legacy companies.
They are completely defying traditional M&A logic and forcing Wall Street banks to at least entertain the math.
It's weaponized sentiment.
Right.
It just invites you to marvel at the sheer chaotic complexity of the current financial ecosystem. I mean, think about everything we have covered today. It is a masterclass in market whiplash.
The divergence of realities is truly profound.
Let's summarize this. You are watching the literal foundational hardware of the artificial intelligence revolution being poured in real time. AMD and Supermicro are securing gigawatt-level contracts, redefining server profitability, and building the infrastructure for sovereign AI in India and Korea.
Right. While simultaneously, you are seeing that exact same AI technology actively changing the live theater of global defense. Palantir is generating 57% free cash flow margins by building software that compresses military targeting cycles to minutes.
Directly monetizing the geopolitical instability of a world where drones are striking the Fujairah pipeline. And then you have the world's largest traditional banks, like HSBC, acting as the physical shock absorbers for that exact instability.
They are raising their expected credit losses, locking $1.3 billion in a vault to protect against inflation, conflict, and the breakdown of global trade.
Meanwhile, the tech titans are entirely unbothered by that physical world friction. Amazon is leveraging its massive AI and automation advantages, the AWS playbook, to wage a structural, deflationary war on the century-old unionized shipping networks of UPS and FedEx.
And finally, just to prove that the market is never entirely rational, you have the retail investor wildcard. GameStop attempting to use a $20 billion loan and internet memes to swallow eBay whole.
It's a day that proves the global economy is as much about human psychology and technological warfare as it is about clean math.
If I can leave you with one final thought to mull over.
Please do.
We spend an inordinate amount of time in the media obsessing over whether AI will replace digital jobs. Will it write code better than a programmer? Will it write articles better than a journalist? Will it automate customer service?
Right, the typical white-collar anxiety.
But when you look at the scale of Amazon's new automated logistics war, and when you look at Palantir integrating AI directly into the kinetic targeting cycles of the U.S. military, I think we are asking the wrong question entirely.
Take that a step further. What is the question we should be asking?
The real question is, how long until artificial intelligence completely rewrites the physical borders, the military doctrines, and the supply chains of our tangible world?
Wow.
We have heard for a decade that data is the new oil. But looking at Amazon deploying 80,000 trailers today, what happens to the global economy when the data companies decide they want to literally own the physical shipping lanes? What happens when the diagnostic X-ray machine of our economy isn't just looking at the bones, but actively rearranging them?
That is an incredible, slightly terrifying thought to end on. What happens when the data companies own the physical shipping lanes?
Thank you for joining us on this deep dive. The world is moving incredibly fast, the headlines are chaotic, and the ticker tape will lie to you if you don't look past the surface. But if you dig into the balance sheets, the mechanisms, and the structural shifts, the real story of the global economy is always there. Keep questioning those headlines, keep demanding to know the how and the why, and we will see you next time.